Chubb Chief Investment Officer at Girard. I'm joined by my colleague Jim Jacobson to share with you some of our thoughts and perspective on the recent volatility and current market environment. It certainly has been a challenging year so far as we adjust the unfolding coronavirus pandemic. Every day it seems to contain a month's worth of news, which has been especially true for the financial markets. As countries, companies, consumers grapple with this health crisis, we are thinking of all of those who are affected by the outbreak, especially those who have fallen ill, and the healthcare professionals on the front lines, many of who are clients, children and grandchildren of clients, working tirelessly to preserve the health and safety of our country. We're also thinking about you, our most valued clients, and your health and welfare during this pandemic. As markets and economies will eventually recover, the health and safety are and your utmost priority in the short term. Before I jump into the thoughts on the market, I want to share a little on our team for those of you who may not be familiar. At Girard, we're long-term investors. We're deeply focused on finding exceptional investment opportunities and uncovering potential risks for our clients. My team oversees the investment strategies that include Girard's clients on our private wealth, corporate retirement, municipal pension platforms, as well as Univest Trust and Estate Services, who in particular has been managing trust assets since 1928. These seasoned investment professionals know how to navigate good markets and bad, mitigate risks, and seize investment opportunities to deliver value back to you, our clients. Quickly, I want to recognize a few colleagues. My colleague Barry Keck, who leads our asset allocation and macro research efforts, Bruce Freeston, who leads our individual stock research, and my colleague Jim joining me on the call today, whose team is tasked with monitoring outside manager due diligence. These research teams are tasked with digesting new information in the markets and economy, retesting tried and true ideas, and ultimately providing our investment committee insights to evaluate and ultimately deliver to our clients. We're here to help with you with your investment strategy questions, concerns, no matter what the market conditions are. Please know also that we've taken all necessary measures to safeguard our Girard team and the communities we live in, asking most of our colleagues to work from home at this time. Our teams are ready and able to provide you with high-quality service that you've become accustomed to at Girard. Our investment team is equipped to operate seamlessly and facilitate trading for you. We've done our best to prepare for the unexpected in advance so we can focus on counseling you during these challenging times, despite that advice coming to you over the phone or via email, as opposed to sitting across from you as we prefer. Rest assured, we're ready to handle whatever comes next, and we'll continue focusing on our mission of being the best stewards of your assets that we can be. Now on to the markets. In the last several weeks, we've seen uncertainty in the markets play out as one of the most volatile periods in more than a decade. After an 11-year bull market, we're experiencing an inevitable downturn, and the daily swings are enough to make anyone feel unsure. Just 21 days after hitting an all-time high February 19th, the S&P 500 has slid into bear market territory, or 20%, the fastest bear market in history. Obviously, no one could have predicted the coronavirus infecting the global economy as it has, or the massive efforts needed to contain its spread and the unintended consequences for the capital markets. Mitigating health risk is of top priority, and in my opinion, the most important variable to getting the next bull market on track. But the containment actions will have significant economic implications. The measures being taken to protect us, to combat the spread of the virus, are positive and appropriate for prioritizing human health, but require large, non-essential sections of the economy to effectively shut down, close schools and businesses to limit human interaction. Having to do so makes it clear that a global recession is at hand. Since January, our investment committee has been discussing the likely impacts of the virus spread through the real economy. From reduced trade, restrictions in supply chains, tighter financial conditions, but perhaps most significantly, the social distancing measures to lead to a profound decline in consumer spending. These certain threats to the economy require swift action by global policymakers, from central banks lowering benchmark interest rates to fiscal stimulus from Congress, which will help those businesses and consumers most sensitive to this temporary yet unprecedented biological crisis. While accommodative monetary policy through low interest rates and asset purchases will provide for functioning capital markets, it will not be a vaccine for the economy and prevent COVID-19 from spreading. In fact, I think if we had a meteor crashing towards Earth right now, our first response might be for the FOMC to lower interest rates. But nonetheless, the actions taken by the Federal Reserve and other central banks should help stabilize financial markets and significantly enhance the rebound on the other side. Coordinated fiscal policy responses are equally or more important and they should be targeted towards industries or consumers who need it most, such as healthcare, small and medium-sized businesses, and those workers in industries hit hardest by few consumers being out and about. These decisive actions can serve as the proverbial shot in the arm to meaningfully shorten the recovery period and minimize the cost of necessary eradication measures to flatten the curve. In my opinion, the key questions to understand the economic rebound are as follows. One, whether the virus can be quickly contained like it has in some other developed countries, an answer difficult for even epidemiologists at this point in time. Two, whether companies, both large and small, have access to enough capital to last 90 to 180 days, a time that most investors would expect will encompass the worst of the crisis here in our country. And three, whether the aforementioned fiscal stimulus acts quickly enough to stabilize the economic and earnings outlook for many publicly and privately held corporations.
And good afternoon, everyone. And Tim, thank you very much for your opening comments and overview. That's very helpful to hear. By way of introduction, my name is Jim Jacobson, and I'm a Senior Vice President and Wealth Advisor, currently here in my 18th year with Girard and my 28th year in the financial advisory industry. As such, I've seen three, I guess we'll call this now three major bear markets, 08, of course, and 01. Personally, I was involved in 1987. I was all of 18 years old and learned a lot of lessons there, which I'm thankful for back then. But professionally now, this will be the third one, and of course, handfuls of corrections along the way. But more interestingly, I am a student of history, and over the last few weeks, I've been wondering what this economy would look like and what it did look like in 1918 when the Spanish flu gripped the world. And so I considered asking my oldest client what her perspective might be on that. But given that she was born in 1926, there really wasn't a whole lot she could tell me. She's only 94 years old. And I mention this because the fact is that our world and our economy has seen pandemics in the past, but not one of this magnitude for literally a century. And since none of us on the call or in this audience today are, 120 years old, we're all in new waters here. So as such, this is new history for all of us in attendance today, but it is not new history to our world as a whole. So let's take a look at what is likely to happen in the short term. And Tim, a few moments ago, you mentioned the R word. We know we have to be careful here with the words we say. That's the R word. So tell us more about the R word, recession.
Sure. Thanks, Jim. Yeah, I think here in the U.S., we do believe a recession will be likely, but we expect it to be short-lived at this point. The second quarter, which starts in April in just about a week, will certainly start out with the largest year-over-year contraction that we've seen due to the unprecedented standstill the U.S. economy is currently in. The markets, both stocks and bonds, have seen the price this recession in, but the markets are forward-looking, and sometimes they're good at predicting future events and sometimes bad. Sometimes they overshoot, and sometimes they aren't able to quantify some of the unintended consequences within the financial markets, as we might see in this current environment. It'll be a trying time, I think, for all of us, and certainly for the U.S. economy, but it also could be one of the shortest recessions in U.S. history. We're optimistic that the medicine our country and economy take now to combat the virus will ultimately dissipate by late in the second quarter. With aggressive fiscal and monetary policy measures, we would expect a sharp rebound in growth during the second half of the year. So the last recession, again, global financial crisis, was deep, rather long and drawn out, as was this economic cycle, which lasted about 11 years. So I think those memories, despite it being so long since the global financial crisis, are still entrenched in a lot of investors' minds, even though it was over a decade ago. Jim, how do you see this recession as being different from before?
So, and that's really, I think, the key question is the last one, as you mentioned, was long and drawn out. I mean, it technically started in late 07, and we finally saw the stock market bottom out in March of 09. And I know just personally going through it with clients, it seemed like it was just never ending, whereas this one is more like going over Niagara Falls in a barrel. We just, boom, boom, we're there. But, yeah, the global financial crisis, and it was global. It wasn't just the U.S. in 08 and 09. It was very long, very severe. And, the entire financial system was shaking. Banking was shaking to its core, and central banks are doing things that they'd never done before. We don't view our current challenge in the same light at all, nor do we believe that a repeat of such an occurrence is in the cards here. The underlying banking structure is much sounder now due to the measures and the stress tests that the Fed has put in place over the years. We often hear them doing another stress test, and I'm sure the bank CEOs and CFOs lament that, but now we know why they do it. This is exactly why they do it, so they can be prepared. So, and that was on top of the fact that in 08 and 09, the banking mess, what we thinned the herd of the weak, and it might be a harsh way to say it, but the fact is a lot of the weak and poorly run banks were thinned out in 08 and 09 and even into 2010. So we started this decade, or I should say that decade, now that we're in a new one here, we started that decade with a thinned herd, a stronger set of banks, and then the Fed has done a very good job. And the regulators, frankly, and I don't mean this to be political, but some of the regulatory reforms were necessary, and that's helped set our financial table much stronger. So from a broader perspective, heading into that downturn too, consumers themselves were living beyond their means. I'm sure we all know people that had bought houses they shouldn't have bought, and they had houses that they couldn't afford to furnish, and then they lost those houses. It is not the same scenario here. Household debt back then was about 134% of gross domestic product, meaning basically our citizens were living 1/3 above that which they produce as a nation, and savings rates were about 3.5%. So consumers since then have improved the balance sheets. Household debt is at a, believe it or not, historically low, 96% of GDP. That number shakes me when I see it. But the fact is, our debt is less than we're producing as a household. And then the savings rate, and I think this is really important. The savings rate is about 8% for the American household, so there is a cushion to fall back on in most cases. Not we're always going to hear those doomsday scenarios where somebody, didn't have savings and really got hit hard. But on average, the Americans have 8% savings. That's good. So many compromised underlying factors within the system required just, complete structural realignment back then. That is not the dynamic that's in play with this. This is a virus, and the recovery is more aligned with, frankly, think of it as like a hurricane that doesn't just hit one side of the coast, but hits the entire country. It's like disaster relief effort coast to coast. So although we do expect that global economies will contract in the second quarter, certainly, we also believe that most will be in a position to rebound strongly later this year and early into next year when the virus-related shock subsides. And then pent-up demand from these consumers emerges. So on top of that, I think of the positive effects that lower mortgage rates and lower fuel prices have for consumers. Now, right now, I haven't worked outside my home for 3 days, so I'm really saving a lot in fuel, and probably a lot of people on this call are the same thing. So that's in a weird sort of way a good thing. And although not everybody can refinance a mortgage, sure an awful lot of people can, so they'll be saving in housing costs. So it's a rare event where, on the one hand, consumers get a shock by not being able to go out and spend at hockey games and baseball games and restaurants, and then we have this shock of seeing mortgage costs and transportation costs going down. And I guess what I'm saying here is, in effect, these are two positive shocks to the consumer. One in the literal mandated restraint on what they can spend money on, and the other on the cost of common things that they bear every day in the form of housing and fuel. So these positive shocks will actually provide a major tailwind for disposable income once we get back on our feet and we're allowed to go out and spend. So I think this is a salient point here. Consumption is being delayed. It's not destroyed. And I'll say that again. Consumption is being delayed. It is not destroyed. So, Tim, I think the natural next question then is, what should investors do? We talked about consumers. We talked about banks. What should investors do at this point?
Yeah, absolutely. And just another point on that with regard to the consumer, we had come into this environment on extraordinarily and historically strong footing. The American unemployment rate was about 3.5%. Wages were growing, especially for bottom wage earners, much higher than even 5%. And we've seen wage growth in the 2 to 3% wage growth range for about everybody. And jobless claims were, at 50-year lows. And so while we'll definitely see those pick up later this week, it would not surprise me if we saw the unemployment rate go from, say, 3.5% all the way up to 7%. In a very short period of time. A lot of that is already priced into the market. And so I think, a key area to look at will be the service economy. How many firms and other professionals like us out there, are fortunate enough to be in careers and jobs where we're not going to be faced with unemployment, and how will they consume, again, once we're able to leave our homes and stop doing conference calls in sweatpants like I am right now. So, but as far as the next natural question, I think for investors, it really comes to their portfolio. And so while I think we would all wish we had the ability to anticipate market drops, go to cash, get right back into equities before the unexpected rally, unfortunately, I've yet to meet a person or investor who can predict the future twice, let alone once. And maybe not everything in cash, but there was some money to be made as a result of the U.S. consumers' mad scramble for toilet paper in the last few weeks. But on a serious note, I think the next best strategy is to diversify and stay the course. And most investors interpret stay the course as batten down the hatches, do nothing. And while considerably better than selling stocks at the worst possible time, doing nothing is also not the best approach. And studies show time in, time out that the best thing to do in a bear market is to rebalance into it, selling strength to buy weakness. But as we know, and this is difficult for even the professionals, sticking with your desired allocation is not easy. But now is not a good time to panic. Panic is not a strategy, and try to change plans. It takes an iron will to buy equities or stocks when they're off 20%, and even more courage to do it when stocks fall another 10%. But since 1940, the S&P 500, so the 500 largest companies in the United States, has declined by 25% within a 2-month period, 67 times in that stretch. So again, since 1940, the S&P 500 has declined 25% or more within 2 months, 67 times. The subsequent 12-month recovery averaged 17%, ranging from 0.11% to over 60%, with a 12-month price return being positive on all 67 periods. So I think the moral of the story is it's incredibly difficult to time the market, and staying the course, rebalancing into the weakness is your best friend, especially for long-term investors who are continuing to save or have a long-term time horizon like many of our pension clients do.
So I think you hit the key thing right there. Hanging in there. I know it's easy to say, it's hard to do. Often we hear this, the term, the old philosopher's term, this too shall pass. And it's, the market hates uncertainty. We hear that a lot too, and that's very, very true. There's not a lot we can say that's true these days, but I think that is very, very true. The market hates uncertainty. It's often said the market can deal with any kind of news as long as it knows what the news is. We hear the phrase, it can climb a wall of worry. And sometimes the market climbs when it shouldn't. Like in the late 90s, we all knew dot-com mania was a little crazy. Bottom line is the markets can go in both directions a lot longer than they should. Fear and greed dominate the short term. I think Buffett said that in the long run, the stock market's a voting machine. I always like to think of the stock market in the short term more like a Jack Russell Terrier that's hyped up on some kind of drugs. It just goes out of control for a while. You got to let it spin itself out. But, the bottom line is making impulsive investment portfolio moves in a time of turbulence is not good. Emotions are for friends, family, and football. Logic is for your money. And again, I know it's easy to say that. It's hard for me to do that. With my parents' money, I have to step away from it, and it's harder for me to manage that portfolio because I'm closely aligned to it emotionally. So bottom line is, hang in there when the waters are murky. I'm reminded of a great quote from Martin Luther King Jr., who said, "You don't have to see the whole staircase, just take the first step." And that in turn makes me recall a very famous scene from Indiana Jones and the Last Crusade. If you remember, Indy's got to work his way through those series of challenges, and he comes upon a bridge, but he doesn't see the bridge. No one can see the bridge. It's the leap of faith, and he reads the book, and he just can't get it, but he finally just has to take the leap of faith, and it's there. And it takes a lot of courage and a lot of faith, but our underlying system is sound, and the bridge is there if we're patient. And another phrase I like to say, I know I'm going on here, but during bear markets, I'll share this one. This is what I say to myself. I'll share it with all of you now, is every day that we're in the bear is another day closer to being out of the bear. So what's old is new, and what's new is old, and what's old is new, and nothing is permanent. And on the flip side of the dark coin, there's amazing things. I think of October of 2008, when Fannie, Freddie, Lehman failed. We all knew they were going to fail, and they did, and the market just freaked out again. And then as recently as 2 years ago, 2018, we saw the market go through a series of rolling sector corrections, and it very nearly had a bear market in the fourth quarter when the major indexes fell about 19%. The market was essentially predicting a recession looming for 2019, and as we know, that did not come to pass. So one more thing, it's often said the market is forward-looking, but it cannot be said that the market is always correct.
Yeah. And the uncertainty of the coronavirus outbreak is certain, all right? There's a lot that we don't know. There's a lot that nobody knows at this point. We need clarity on a lot of fronts, but, something that we learn in the few weeks ahead may set back the markets temporarily. We know bad economic data. The question is how bad. As I mentioned before, spoiler alert, jobless claims are not going to look good later this week. But that could be completely priced into the market, or they could be a lot better than what the market has already been expecting. We know policymakers will respond. We got some clarity around that last night in the wee hours of the morning. But the question will be, how strongly do they need to respond if things continue to get worse? And then I also know we'll hear from some amazing Americans coming together to help one another during this challenging time. But as you mentioned, bear markets and drawdowns in equity markets are really the price of admission for being a long-term investor. And making impulsive investment portfolio moves in a time of turbulence is never a wise move. In the end, I truly think that the capital markets and the global economies will be resilient. And certainly both of us have spoken to many investors in the last decade who made unfortunate market timing decisions during or after the global financial crisis that to this day that they still regret. The bottom line, markets will reach this point from time to time, and global equity markets have experienced 8 bear markets over the last 40 years, or roughly 1 every 5. We've seen 13 corrections. That's about 1 every year. And during that time, global equities have increased a magnitude of 17 times. So for those who can stomach the short-term crisis, it can present a long-term opportunity that should be rewarded for years to come. So hang in there. This too shall pass.
Tim, I'll jump back in, and I'm just sitting here contemplating my conversation with my 94-year-old, and then I'm contemplating conversations with some of our younger colleagues who, might be 23, 24. And it's interesting to think of the 94-year-old probably opened up a Sears catalog in 1945 and ordered something from it, maybe 1946 when the war was over. And then that's the way it was for 40 or 45 years. And, then Walmart came to town and Target opened up stores. And the next thing you know, everybody's shopping there and Sears is fading out. And that's the way it was. And then somebody comes up with Amazon, and next thing you know, they're moving beyond books, and by 2003 and 4, they're peddling everything through this thing called the web. And I think of all these youngsters that don't know what the Sears catalog is, and that's maybe a good thing. So what I'm illustrating here is that's the force of creative destruction. That the great economist Joseph Schumpeter coined that term, creative destruction, and it's not pleasant. It's not a pleasant process, but it's a necessary process. That general store out on the frontier was crushed by Sears and the catalog that came in the 30s and 40s. And then Sears was crushed by Walmart and Target, and then Amazon puts pressure on Walmart and Target. They, in turn, respond with their own online services. And the bottom line is these companies now employ hundreds of thousands of people, whereas Sears employed maybe tens of thousands. And the same thing in the early 80s when Lotus 1-2-3 and Microsoft Excel came out. There was a great cry from the accounting. If anybody in the field today are accountants, you probably remember this. There was a great cry that the accounting industry would be turned upside down. We had something like 850,000 accountants in 1984. Now we have 1.3 million. I don't know. Maybe that tells us something about the tax code. But the point is the creative destruction, these forces, we can't even figure out what's going to come out of this, but there's going to be good things that come out of it, and that's where the investment opportunity is. So if anybody knows exactly what it is, let me know. I would love to know that, but I just know that in general, and this is what Warren Buffett would say too, you just ride the American wave. You ride that American tailwind, and it's there. And it's not just America too. I mean, there's plenty of countries outside our borders that are very, very good. But, we have something here that's pretty special, and it's not perfect, and it never will be perfect because we're humans. But the fact is it's pretty good, and I think you gotta hang in there. You got to ride the wave. As Tim said, you rebalance down into this. You look at it logically, keep the emotions for friend, family, and football, and you just grind through it, and it does. It works. Warren Buffett wasn't born a billionaire. I mean, he was born a kid delivering newspapers in Omaha. I think he's done all right just especially buying when things are down.
Yeah, I'm sure Omaha has been pretty quiet the last couple of days. I'm sure we'll hear some news from them in the future. But just wrapping up with some more thoughts around COVID-19, and I think that's really helpful perspective. As we talk to our investors today, looking for some green shoots, looking for some opportunities, or at least things that the media may not be talking about in this order as it relates to how we're going to get out of this crisis. And I think the first and foremost, and I said this earlier, the most important variable on this is science. I'm not an epidemiologist. We know that the cases will continue to tick up. We know that we're going to go into a mild recession. But the question is, how wide is the river? We already know how deep it is. And so I think as we can do the best we can as Americans and flattening the curve, practicing social distancing, being patient for successful vaccines and therapies, which will ultimately get Americans back on their feet, and having fiscal policy and monetary policy, I would say, is 2 and 3 to help shepherd us through this period of uncertainty, make sure Americans aren't losing their homes, and that once we can, get back on our feet, that the consumption is not destroyed, as you said earlier, but just delayed. And I think the fourth and foremost, confidence needs to come back. We're speaking with our clients today. All of them, I would hope, are at home practicing social distancing. I think we've seen confidence be shattered, and especially as we go through, this challenging, what will likely be a couple of weeks here, it's really important that we come out of this and we can get consumer confidence back on track and back consuming. But the Fed and I think Congress will ultimately do what they need to do. The U.S. GDP is around $21 to $22 trillion. We've been hearing the stimulus package is somewhere between 5 and 10% of that, especially when you incorporate what the Federal Reserve has and will be doing as far as supporting small and medium-sized businesses. It basically replaces the GDP within the second quarter alone. The Fed has been enormously proactive in a way that's been completely remarkable. And in this true crisis, they very much have stood up and delivered. So I think the Fed's done an exemplary job. And, like you said before, looking at the financial sector, which ultimately may bring, the U.S. economy back out of this, it's enormously healthy right now. U.S. banks are sitting on close to, I think, $1.6 trillion of what I'll call security reserves. And so while the scale of the crisis that we're facing is significant, I think we've prioritized our problems, and I think we'll come out of this even stronger than before.
Well, that's good, Tim. I think I'm concluded with my comments. I know we're coming up on our half-hour time frame, so maybe go ahead and take us on out.
Yep. Sure. So today we addressed some of the common questions we've been receiving from you, our clients, recently, and we know you have some additional questions or concerns. Your team at Girard is here to answer those questions and help guide you through this. We are in this together. We'll get through it together. And all of us at Girard are thinking about you and your families and hope that everyone stays safe and healthy. Thanks for joining us this afternoon.
This concludes today's Girard Town Hall. We appreciate you taking the time to join us. Have a good day.